Okay, let me start the webinar. Good day to one and all. This is Dr. Sivaraman of iknowindustries.com. Sorry. I'll be presenting Tracking the Forex Market Together webinar part 2 between 13 and 13:45 GMT. So the part 1 I have given it between 9 and 9:45 GMT, explaining the simple market tracking technique, our market reading technique, and also how effectively we can develop a trading strategy using the hedging order. So in the market tracking technique, we track the market using the live market code page, follow the times followed by that of the big players, and also read the type of moves so that we are in a position to understand what is going to be the next move. Then accordingly, we aim for a swing trade. And after taking the position, still we do not want to take unlimited risk. So we keep 30 pips hedge order instead of a stop. So once we keep the hedge order, if the position is filled, the hedge order is filled, we will be able to review it in relation to that of the market moves during the course. We watch for 30 minutes. If the hedging is not making profit, we try to close it with a nominal loss and keep another hedge order to limit the risk. The hedging is making profit, we try to keep stop at entry and then trail the stop in the profit-making hedging and try to watch the market, how far they are coming down. And once they stop cutting the new low, we try to book profit on the downside and keep another hedging order 30 pips below the market. And once they start gaining the levels on the upside, then we try to book profit on the buy side as well. So these things I explained it during part 1 of the Tracking the Forex Market Together webinar, and that is being recorded. And if you go to fxtrade.com and click webinars, in the header, you'll find it is already displayed. Part 1 is being displayed, and if you're interested, you can just listen to that. Then we are in part 2. So in part 1, I had taken some positions and we like to know what happened to those positions. And also I'll explain to you what is the current market condition when compared to that of the initial lows and the highs at around 3:30 GMT. So these are all the positions I just entered into the market during part 1 of this webinar. And currently, let us compare it with the other market. Now, when Euro was not filling it around 1.3610 during that mid-session, so I just taken a buy position around 1.3626 and kept 30 pips below the hedge order, 1.3594, and kept the limit order. But you know that it is making a very subdued move, and it is currently showing about 25 to 26 pips loss. Then GBP 63.50, I took the buy position, and which is under loss, and currently the market is 63.32. And if you watch the live market code page, you find all the currencies are in negative net change. So when all the currencies are showing negative net change, is a typical contrarian move wherein Euro, GBP, and Australian dollar are showing the USD gaining move. Japanese yen, Swiss franc, and Canadian dollar are showing USD weakening move. So this sort of contrarian move, they try to do it in order to handle the process. And 13:30 GMT, there are some data to be released. Before that, they are trying to handle the process. And you know that from that of yesterday until that of the early European session, they have been handling the commodity crosses, and now they started handling the European handling the yen crosses. That is why you come across USD yen is just cut the low and it is staying closer to the low, when Euro and GBP have just done the dip. So I will not close the position, and we will watch because it is just the late session, from 12:30 to 14 GMT. So during the course of this time, we will watch the market and try to see how exactly we are going to handle these positions. Now coming to that of the present webinar. So I take into consideration the statistically derived algorithm-based forecast, and that I show it during that of the Asian Session Live Market Analysis webinar on Mondays and Thursdays. So this is the expected market moves for 16th, and they made the dip and then rise, and they are expected to rise during the late European session from 12:30 to 14 GMT. Since 13:30 GMT, there is a data release, and they are just hovering around, and towards the data release time, they are expected to make a false move and then the intentional move. Then swing and rise moves are expected during the US session. So this is the forecast part of it. Now coming to the market reading. So Euro has breached the high, the initial high set around 3:30 GMT during the Japanese session. It went up to 1.3628, and then the low is 1.3586. They have not breached the low. And in the case of GBP, 1.6347 is the initial low, and the high was 1.6376. They went above that of the initial high, initial low, and did not sustain there for more than 30 minutes. And soon after the first part of the webinar, they started making a dip. So anyhow, they will be making further rise again. So anyhow, if they come down and hit hedge also around the hedge order placed, and still we will be able to handle the hedge on the downside and then handle the buy position on the upside also. So we are not afraid which way they are going to take the market. As long as they are able to make swings in the market, we'll continue to make profit. Then in the case of yen, 104.56 was the initial low, and they just breached it by 2 pips. 104.54 has become the low, and they are holding closer to the low, 104.6264. And for the data release, they are expected to push down USD yen, and then which will trigger Euro and GBP to go up, and that way they will be able to handle the yen crosses. So yen crosses Euro yen and GBP yen, they are holding almost flat, and they have built the sell positions, and we will see that how exactly they are handling it once the data is out. So that is why they just made Euro is in the middle level, GBP is in the middle level, whereas USD is closer to the low. When they make the contrarian move, we can do a technical trade of sell and buy in the case of yen crosses, because they will push initially Euro, GBP and USD for some time, and then quickly drop USD, and which will trigger Euro and GBP to rise and make the USD weakening move. And that is how they alternate the moves. So when you do the sell and buy trade, still we need to use the hedge order of 50 pips in the case of crosses. And once the position makes profit, we have to keep stop at entry. So they have been doing the high level consolidation in the case of USD in order to make a drop again and come down to that of 102, 101 area before making a big rise by month end. Then in the case of CHF, they just breached the low 90.83 and formed 90.80 and 78, and then subsequently they come down to that level of 90.62 and holding below that of the initial low. So when Euro is showing negative net change, USD CHF is also showing negative net change. As a result, you will find a drop in the case of Euro CHF, 13 pips. So they wanted to push down Euro CHF and also GBP CHF. GBP is negative net change, CHF is negative net change. So this way they handle the process. So we need to understand what they are handling at a given time. When they are handling the process, we cannot expect much of a move in the case of the majors. And slowly they will come to that of the majors towards the data release time. At the time, we can watch and close the position. And in the case of Canadian dollar, they just breached the low 1.0934 and came below by about 11 pips to 1.0921 and holding closer to that. In the case of CAD, holding below that of the initial low in order to make a drop. And in the case of Australian dollar, they just breached the low by 20 pips, and then subsequently it has come to that level of 87.93 now. So slowly they are expected to come above that, and later on we'll find that it will be lagging behind in gaining the levels, because once they drop more than 75 pips, they don't reverse it on the same day. They reverse it on the next day. But once they make only about 75 pips net change level, negative or positive, and hold, then they can reverse it on the same day. So that is how they do that. And so at the moment, they are making only a nominal negative and positive net changes, and they are expected to make the late session moves. So when you see that the denominator currencies have shown the negative net changes and breaching the lows, a numerator currency like euro, which has not breached the low, whereas it has breached the high, and GBP has breached the low during start of the European session, but it has not breached the high. CHF has breached the low, and Canadian dollar has breached the low, and Australian dollar, the new low, they have breached it and still holding below that of the initial low. So this is the condition we come across using the initial lows and the highs. So in the market trading, what we try to do is, we note down the initial lows and the highs around 330 GMT and try to compare it with that of the current market condition. In the event, if you are not able to note down the initial lows and the highs during that of the Japanese session, suppose you are in US and not in a position to watch it, doesn't matter. You can just note down the current lows and the highs in any currency, and especially look into that of all the 6 majors, the 4 majors and 2 commodity pairs, and try to see what sort of moves they are doing it by looking into the net changes to start with. When they make the USD gaining or the USD weakening move, we can take positions in the case of majors. When they are making a contrarian move of this nature, we can only take position in the case of the crosses in order to earn some profit. Otherwise, the holding time will be prolonged whenever they are making the contrarian move, and they enter a position in the case of the majors. Then we follow the market trading technique and try to take the positions. But still, we do not want to take chance with regard to our equity, because our equity is very limited. So we need to conservatively trade and earn from the other market, and also minimize the risk and maximize the profit. How we can do that? So we use the hedging order instead of the stop. And always we try to enter into the market whenever there is a quick move happening. So normally the quick moves, they do it during that of the early and the late part of the sessions, and the mid sessions they'll be making slow moves. So these are all the session timings. So Japanese, European, the US session, and in between you come across the gap time. So now we are in the late European session, 12:30 onwards up to 14 GMT. So we have started the webinar by 13 GMT, and the webinar will go till 13:45, and 14 GMT, up to 14 GMT, the European session will be there. And here I have given how exactly the players have divided the entire market, the global market, a 24 hours market, in terms of GMT time frame. And so it is better to track the market using the GMT time frame rather than trying to convert it into your local time and try to do it. It is something like when all say that the earth is revolving around that of sun, but for a convenience, we say that the sun rises in the morning and set in the evening. But that is not true. Actual phenomenon is the globe is rotating. So when you go in for the global time, then it is not advisable to convert into your local time and try to practice it. Instead, You go to the global time, understand the global moves, and understand how exactly during different sessions they make different moves. Then you will be able to understand the market is a continuous process. It's not like a stock market wherein it starts in a specific time during the day, in the morning, and it just gets over in the evening. But it is a currency market, and also in the online trading you find all the markets undergo this 24-hour cycle. So it is better to follow that 24-hour cycle and read it in terms of the GMT, so that we'll be able to understand the morning starts in Japanese session, and then subsequently it might be night in Europe, but subsequently you find European morning starts and it will be evening here. Then the US morning starts, then it will be afternoon and then late evening. So that is how you will feel. And once you see that evening time comes in, you become mentally fatigued and tired. And once it comes to night and midnight, you become tired. But when you follow the market using the global time, then you understand that the market is not yet over, so that you will be able to really participate and read the intentions of the players and try to trade. And I'm not insisting you to watch all the 3 sessions, but choose any 2 sessions which is convenient for you, because you will be able to keep awake at least for 12 to 14 hours. And in that process, try to see what they are trying to do it in the market. It's not necessary that you need to watch all the 3 sessions of the day, but the day starts from the in the GMT time frame, the early Japanese session, and gets over by US session. And that is why the live market quote page, the net change is from the previous day US session close time. Sorry. So we have just done the live market quote page and also noted down the initial lows and the highs. They are making the swings. We have just understood. And I like to explain with regard to the type of moves they are trying to do it during different sessions. And if you take into consideration the market timings. So what they do is, the type of moves, as I explained, that when the day starts, they will make either upward or a downward stop hunt. Now, the type of moves are namely stop hunt, false move, then extended move, intentional move, and the swings. Let me show the slide. Okay, stop hunt, false move, extended move, intentional move, and swings. The stop hunt and false move happen in less than 30 minutes. For about 15 to 25 pips above that of the high or below that of the low, they are set. Then extended move is for 2 hours, 30 minutes, beyond 30 minutes, and up to 2 hours. And then they reverse the market. These are all the type of moves they do it in order to bring in intraday trend reversals. Then more than 2 sessions, they try to make the intentional move, which will be a slow move, when compared to that of extended move, which will be a quick move. And this move, they just cut the high and stay above that of the initial high and continue to gain the levels upward, or cut the low and stay below that of the low and continue to drop further down for 2 sessions and the start of the 3rd session. Swing is the one what they are trying to do it without breaching the high, without breaching the low. They just make a small 10 to 15 pips or sometimes 23 pips swings near that of the high, near that of the low, or between the low and the high, etc. So now during that of the day, during the early Japanese session, they either make a downward stop hunt or an upward stop hunt and then reverse in less than 30 minutes and continue to make the swings during that of the mid session. And during the late session, if they would have done the downward stop hunt, then they will firm up. If they would have done the upward stop hunt, they will make the slide. So irrespective of the data release or whatever it is. So keep in mind that is how they make the moves, and around 3:30 GMT, they just set the initial lows and the highs, and also try to increase the spread between the initial low and the low and the high for more than 30 minutes in order to actively make moves in a currency pair. Then afterwards, the opposite of the start, they have done it and they do it during the late session. Then afterwards the gap time. So if they have gained the level, they will make a dip in first 15 minutes of the gap time. Then the remaining 15 minutes, they will try to form up. And then without breaching the high, they will try to make a downward move during the early European session in order to create the fear for that of the traders, and the traders might perceive that the market is lackluster or the market is not having strength to go up. So it is coming down. So quickly, as soon as the market starts, many people try to take sell positions after the drop. They accumulate all the sells. Then the players slowly gain the levels during the mid-session and the late session. So they know very well, those who are holding long position, they are so weak-minded when compared to that of those who are holding sell positions in the market. So when they make a small dip, the long holders liquidate the long position because they fail to use the stop or the hedging order. Then they try to gain the levels or drop the levels depending upon the type of moves they are trying to do it, whether it is an extended downward move or intentional move. Once they start the intentional move from that of the European session, they continue it to that of the next session also. They slowly breach the low every 30 minutes and pip by pip they make the market to drop. If they are gaining it also, then pip by pip, they will gain the levels and continue to gain the levels during the US session. Then European will be the first session, US will be the second session. The next day Japanese session, they will make an upward stop and then start dropping it. The third session, they reverse the market. So intraday trend reversal is a must in the market for the players to make money. It is not that they are going to benefit by strengthening or weakening Euro or GBP and things like that. They are not worried about it at all. And the data release is there. And so when the data release comes like this, and the time is also given with regard to the data release, and immediately the players use it as a trigger time and try to make the moves in the market. And that way, they are able to go against that of the technicals. So they will make the market appear technical, following the technicals. And suddenly when the data release comes, they will make the opposite move and say that because of fundamentals, the market has just reversed. And when you think that, okay, the market has reversed, then you will find the technicals will come into play as overbought or oversold conditions, and then they reverse it. And again, when you see that, okay, technical only works in the market and try to take position, suddenly they will say, okay, fundamentally this is what happened. So they make the opposite. So ultimately what happens, they just create the market sentiment and act against that of the traders. And you have to understand two pairs only they handle at a given time. So those two pairs you should be in a position to identify, and those two pairs will normally make about 40 pips spread between the high and the low during the Japanese session, and they will be handling those currencies. Subsequently, they will shift it to focus it to the other currencies. So all 6 pairs they will not handle at a time. They only handle 2 pairs at a time in order to bring in the volatility in the respective crosses. Then they will take another 2 pair and bring it. That is what they have done it during the Japanese session, the commodity crosses. And now they are coming to the yen crosses. So all the currencies are showing negative net change before that of the data release by 13:30 GMT. So I explained how exactly they use the stop and the extended move and the intentional move. The false move happens during that of the gap time and also before that of the data release. So 13:30 is the data release time. So they will quickly bring in much of a volatility in the market around 13:25 to 13:30, and that will create the fear to the traders. And they will make in the platform, if you see it, because here it is not getting updated so quickly, in the platform you will find the codes oscillate in a very big way, and quickly the orders will come in because in the platform they just show fifth decimal also. And that will induce the traders that the stop might be hit. And that they do it mainly for the platform providers to do their own stop-ins for their clients. So they do the stop-ins for their clients, and then subsequently you find the market make a jump either on the upward or on the downside. And the platform providers will say that we don't guarantee a definite fill. And some people say that we give guaranteed fill excepting on certain occasions. And that is how they continue to change the explanations from time to time. So we have to digest it and try to act smartly, because there is no point in blaming them, because we all need to trade only through the online trading platform providers, the brokers. And there we need to understand the limitations we face with regard to the brokers and then outsmart them. So how we can outsmart? We can take only very less position and use the hedging order instead of stop. If you use the stop and the trailing stop, they will definitely make a fill, even if it is about 5 to 10 pips away from the other market. They will say that because the market was so volatile, it has failed it. We have not done anything. So now with regard to the trading strategy, so we keep 30 pips stop. Why we should choose 30 pips? Because market is stagnant, so I am using the time to explain. See, normally the moves, they do it until it is closer to the data release. It will be for about 12 to 15 pips on the upside and the downside. That is what they do it. Below that of the low, they go up to that of 23 pips. Or above that of the high, they go up to that of 5 to 23 pips. So if you keep 30 pips hedge order or a stop, it is unlikely to get filled unless and otherwise it is a very quick move. So instead of stop, we can use the hedge order, so that once the position is hedged, we can review it in relation to the other market and say that, okay, due to stop and it was hit and nothing to do with the other market going against me. So we can just close the hedge order and keep another hedge order about 10 to 15 pips or 30 pips away from that other market. And once they start making the move in your favor, then move the hedge order closer to that of the original position, and then try to keep stop at entry once the position makes profit of about 15 to 25 pips, and then try to maximize the profit using a trailing stop and also a limit. Initially, you can keep the exit 45 pips from that of the entry, and if the market swing is very good, you can make it up to 75 pips. In the event if you identify the intentional move is there, then keep a limit of 150 pips. We'll be able to see that the limit order is being filled. So this is how we should be able to maximize the profit. It is not that once you take the position, you become afraid and try to close it with 5 pips profit or 10 pips profit and things like that. So when the fear is there, then you don't intend to maximize the profit. So how to get rid of the fear? You can get rid of the fear by keeping the stop or the hedge order, but invariably the stop is not eliminating the fear. Instead, it aggravates. So when it comes closer to the stop, immediately many people have got the tendency to move the stop away from it. Move the stop away from it. And without their knowledge, they would have moved about 40-50 pips away from the original position. Then later on, they realize that equity is getting eroded. So it is a very unfortunate situation that the market fear has to be eliminated. And in order to eliminate the market fear, and if the hedging facility is not available in the trading platform, especially the US trading platform, where the leverage is also very less, 1:50 and things like that. So in such a situation, then don't take any position when the market is of this nature, when it is subdued. When they start making a quick move, either on the upside or on the downside, then watch 30 minutes after that. When you watch 30 minutes, when the move starts and stop cutting the new high, then take a sell position and keep 30 pips stop. And you know that first level rise, they just continue to buy it at the market by circular trade. Then second level buy, they will make it. And that second level buy at the higher level is to induce the short sellers to come for a short covering. Then the third level rise, they make it. And that is to induce all the emotional traders to buy it at the highest level before they make the drop. So up to first level, they buy. The second level and the third level, they use specific orders so that they don't buy it at the higher level. They only trigger the market to go up and they continue to sell. That is why during such moves, when you place order, your order is not filled. And they are called all or none orders. So your order will not be filled and the market will make the jump. Only with the help of the bank trading platform, they will be able to do that. And then you become afraid why it is not filled and things like that. So ultimately, they don't buy at the highest level. They don't sell at the lowest level. And they only make all of us fool to buy at the highest level and sell at the lowest level. That is the trick of the trade. So that we need to understand. Once they stop cutting the new high for more than 30 minutes, that means people have started turning long. So once they rise from there, what will happen? Those who have taken the long position will book profit. First of all, what they have to do? They have to avoid the higher level long holders not to book profit. Only then when they drop, they come for the liquidation of the long position. Similarly, during the drop, you know that Australian dollar, when it was dropping, everybody was induced to sell. And the call was it will go to 0.85. It might go, but it will not go immediately. Already they have dropped about 115 pips in the morning. And how exactly they can make indefinite drop in a currency? So that is how they create the feel. And you know that for net permitted level, in the case of Aussie, is only 100 pips. Still, it is in excess. So they will definitely recover. So if you understand that, you will not sell after the drop or buy after the rise. We may call it as a breakout trade, but breakout trade need to be sensible. Not to buy at the highest level and get punished, or sell at the lowest level and get punished. So this is how we have to understand the intentions of the players and then try to take the positions. You know that they made the dip before the data release. Now, once the data is out, they started gaining the levels here. And you know that, as I explained, USDN is the first one to create the feel in the market, and we just made the dip. And they will continue to dip and change the market sentiment. So GBP drops and create the bearish feel. USDN drops and create the bullish feel in the market. So track these two currencies. We'll be able to really understand what they intend to do with it. We'll go to that of the original position. So I'm not going to take any fresh positions. I'll just compare it with the current holdings. Actually, the webinar started around 9 GMT. So the ideal time to take will be 30 minutes from the start of the session. 8 GMT, the European session starts, and 8:30, if we take a position, I would have taken at a lower level, and now it will be at the break-even or with a profit. Doesn't matter. And I told you during the part 1 that the market will make the move in my favor, and instead of 50 pips, I may make about 40 pips profit. That is the only difference. So they just started gaining the levels, and USDN, see how they are making the big drop, and they will make towards the close and the US session for the drop, and all the sentiments will be changed. So they create the market sentiment and act against that of the traders. Now Australian dollar started making the profit, so we can keep, once it gains above 88 level and stay there, we can keep stop at entry and try to maximize the profit. So even though the market was making the downward move, we did not get the edge order filled. So that means they just created the bearish feel but they are not given the profit booking opportunity to the short sellers. Even though the market was looking very weak and the Euro GBP were looking very heavy, but they are not given profit booking opportunity. That is what we need to understand. So when we look into the early session move, we can predict what the late session they are going to do it. Is it difficult? So if you understand the trick, then you need not complicate yourself by thinking about various types of market analysis. Make your analysis as simple as possible so that you'll be able to focus more on the market, live market trading rather than the reading of the market after the events. See, we can always make the market comments by looking at the chart of the previous days and say that, okay, market has undergone this retracement, Fibonacci retracement, and it is just MACD crossover, RSI crossover. All we can explain it, but that is of academic interest. But if I want to know whether euro is to go up or come down at a given time in the live market analysis, the best tool will be the tick chart. And the tick chart, if you look into, it will be very unwieldy. No, it will continue to move. You will not be able to do any sort of study. Instead, if you use the live market code page, you find the action before you. Probably it might be about 5 to 10 seconds delayed, but still you will be able to see that. In the platform, we also see the codes. But the thing is, the move is so fast and you will not be able to really understand what they are trying to do it. And also, in order to confuse the traders, they keep their arrow marks up and down and things like that. So don't look into it. And they are all only the moves for about the seconds. But actual move, we'll be able to see it in terms of the net change. Okay, euro has gained about 16 pips from that of the previous day close. Yen has dropped about 14 pips from that of the previous day close. And GBP is still 20 pips below that of yesterday's close level. You can simply read it and say that, okay, excepting Australian dollar, none of the currencies they made any big moves since that of the Japanese session. But if you look into that of the charts, you will be able to find that they have done so much in the market. But actually what has happened, when the moves become very narrowed, the chart gets magnified. And even 5 pips drop will show a big candle, red candle on the downside, which will trigger your emotions. Then you feel that it is better to close your position. Or when a green candle forms, which might be about 5 to 7 pips, when 3 candles form, immediately you feel like go and buy it. But obviously they are done only about 15 pips move. So ultimately, by looking at the net change, you can understand how many pips they are done in, whether it's worth taking a position. So that sort of analysis, objective analysis, is very much needed, and we should not magnify it. It is when you try to magnify the moves, and that is automatically built in the chart sheets. And so invariably, when the move becomes small, that chart gets widened. So you have to, and when you go in for a longer time frame, then the moves become reduced. So when you go for a shorter time frame, then the moves become, or the candles become very big, but the spread in the candle might be about 5 to 7 pips. And in a longer time frame, it might be about 20 to 30 pips. But invariably what we do, we use the long-term chart as well as the short-term chart in order to fine-tune our study. But instead of those things, we simply use the live market code page, understand what they are trying to do it in relation to the yesterday's close level, and whether they wanted to rise or drop by comparing to that of the highs and the lows. We'll be able to easily make up what they intend to do and accordingly take positions and try to book profit. See, our study, if it becomes simple, and still we understand that nobody will be able to predict the market 100% perfect. So in such a scenario, we need to focus more on the trading strategy. The trading strategy, we can use either stop if the hedging is not available, hedging facility is not available. And if The hedging facility is available. Effectively use the hedging in your trading strategy. As I explained, the hedging can be used instead of a stop, and it can be used for either way trading in the market, because either they can rise the market or drop the market, and beyond that they cannot do anything. And they cannot continuously drop the market endlessly or continuously rise the market endlessly. And if you simply take the positions and if it is hedged and you wait calmly, you will be able to see either side will be able to book profit, because the players need to trap the short sellers and that of the long holders alternatively, because they try to create the bullish sentiment and induce the traders to buy after the rise, create the bearish sentiment and induce the traders to sell after the drop. So don't become the victim of such act, even though they don't put their hand through the computer and just ask you to liquidate your long position at the lower level, ask you to sell after the drop, but they trigger our emotions. So once they trigger our emotions, automatically nobody need to tell us we going for a distress trade. So avoid doing it. And how you can avoid doing it? Stop gazing into the other chart continuously. Because once you find the big candle formation, immediately you are taken aback, and which triggers you to going for a distress trade. Instead, use the live market code page, and wherever you are comfortable, you just look into it. If you develop the practice of looking to the live market code page, you will not be really needing any other tool other than the live market code page in order to successfully earn about 30-40 pips or 50-60 pips from that of the market on a daily basis. Because we are not here to give any sort of advice to that of the respective governments like the Eurozone or the BOE, etc. with regard to the currency strength and weakness. We are here only to trade in a leverage condition. In the leverage condition, whatever the position you take, you have to square it in the market. If it is delivery based, that is currency conversion, then probably you can do that sort of long-term study. But invariably, you would have noticed that all the long-term calls at a given time might appear possible. And last year, during the month of during the month of April, May, I suppose, when Euro and GBP are not in a position to gain levels, many of them have given the call, because I have seen in FX Trade the experts giving the call that Euro will come to 1.25 and GBP will go to that of 1.43 and etc. Because when you look into the chart, we will find that it is a continuous regression on the downside. But we fail to understand the market cannot make such moves, and it can always change its course. And ultimately, the year end all went up. And we have seen all the currencies, Euro, USDN, as well as GBP, gone up last year. And this is how they make the moves, contrarian moves. Unless and otherwise we understand what sort of moves they are doing it in the market, then theoretically we will try to follow the old system of understanding the market. And that we have just made everything modern in our life, and everything improvised, and including food, the hairstyle, and also the dress, etc. But with regard to the market study, still we use the conventional study when the market was not manipulated. When the markets were not manipulated, such statistics were working very effectively. But when the market is being aggressively manipulated, how exactly it is going to work in the market? That we need to understand. So there was no expert to do the further studies with regard to all the statistical analysis. And invariably what happened, that only the tools were developed by that of the software people for that of the respective software analysis. Unfortunately, that many of the tools which say that they are giving the RSI and MACD and things like that and pivot point, I just tested those things, and there are a lot of errors with regard to that. And many of the tools which are provided, because ultimately the statistician gives the information to the software engineer. And the software engineer just do the coding and try to give that of the charts formation or this technical analysis studies, etc. But when you look into that, you find that there are a lot of errors coming in, and there is no one to point out the errors which are coming out out of the statistical estimate, and especially with regard to all the chart study. And everybody simply or blindly follow the charts, and when they say subcomponents, and immediately they go in for that and see that, okay, I am just using this sort of the simple moving average or a different time frame, etc. So they only use it, but unfortunately, it is not picking up the even study. It is only picking up the random study and try to give the simple moving average and weighted moving average, etc. So there is no one to really back test all the softwares which are available to do the chart study and say that, okay, where the errors are, how to rectify it. And it is very unfortunate, but it is liberally available for free for everybody. And you just use a simple comparison, use two different chart systems and try to see whether they are showing the same value simultaneously when the market is making the move. Then you will be able to really understand that they are all developed by that of the software engineers, but they do not know anything about statistics or about the market. So when such people develop it and those who are experienced use it, it's a very unfortunate situation. Okay. So now we see that Euro is in profit and GBP has also come to that level. And when you watch till 14 GMT or 1330, now it is 1347 GMT, 14 GMT, the US European session will get over. And I have not looked into that of the data, but I was telling you that they made the downward shot and they will gain the levels during that of the US late European session. That is what they have done it. And USDN, they just made a quick drop in order to change the sentiment. And you know how exactly they made the moves and what the charts can tell us with regard to these moves. And so immediately we'll try to draw the line and say that, okay, this is the support, this is the resistance. But here you find at every drop they stall and induce the traders to buy before making further drop. And these things we need to understand practically, and that is going to help us in our trading decisions. Let me try to answer to the questions which are asked here. And go to this. Okay. Now, Greg, can you hold on the buy positions on Euro and Aussie or exit because it does not go up? See, this is what the emotion tells the person. So ultimately, when you see that, they create the market sentiment in such a way, a false move before that of the data release. Invariably, you find that we tend to exit out of the position. You know, I had taken a higher level long position. I was holding it because I had taken it during that of the mid session. It doesn't matter. Still, I was telling you that early session they made the drop, so they are expected to make the gain in the case of Euro and GBP. So I was holding the position. During the mid session, they will try to make some swings. We should not be afraid of it. And why? How do you determine which two pairs are being handled? Okay, as I explained that if you watch from the Japanese session, you will know that any pair which makes more than 40 pips spread between the high and the low, that pair they are handling it. You see invariably that they either handle the yen and Australian dollar during the Japanese session. Then slowly they start handling Euro and GBP during the early European session. Then afterwards, they increase the spread in the case of CHF and Canadian dollar. So they should make the spread more than 40 pips between the high and the low. And that currency pair, they will be handling it. Still, you find that excepting euro, all our currencies are showing negative net change. We are still trying to handle the crosses. And later on tomorrow, they want to make an upward squeeze. Induce the traders to go in for the short selling or a pullback sell and things like that. And later on, just to punish. After the bearish market, they punish the short sellers. And after the bullish market, they punish the long holders. Right. During our weekly forecast, you may say swing and rise. But we know that numerator currencies generally move contrary to the denominator currencies. Okay. Now, as far as the swing and rise and swing and drop moves are concerned, we need to understand, as I explained with the help of the market timings. Okay. With regard to the market timings, so the early session, they try to make either upward swing or the downward swing. Early session, they make an upward or the downward swing. So the gap time move will indicate whether it's going to be a downward swing or an upward swing. So if you continue to watch the market for at least 2 sessions, then the second session you will be able to really predict. You may not be able to take immediately positions during Japanese session, but you can easily predict the European and the US session moves and try to take the position when it is a downward move. Always keep in mind they make the lower level consolidation with a downward stop in order to rise, so that there will be least selling pressure when they rise, because all the long holders are stopped out. Similarly, when they quickly gain the levels, they do the higher level consolidation with the upward stop in order to drop. What else they can do as a cunning fellow? So any cunning fellow will try to pretend. So that is what they are trying to do that. Only then they can earn from you. See, you honestly think that the market is very, very honest and reflect on the economic conditions, etc. But they try to create the sentiment by making the downward move with a downward stop and immediately become bearish. That is why I always say that don't turn bearish and bullish. You just see whether it can buy and sell or sell and buy trade. You can do it. And avoid using the word bearish and bullish, which will induce you to become emotional without your knowledge. Then you go in for a distress trade. So when they make the swing on the higher level, that means they want to drop. When they make the lower level swing, that means they want to rise. I'll tell you the secret. When they continue to hold near the low for a prolonged period, understand with the downward stop and understand they wanted to make a big rise. When they continue to hold near the high with the upward stop and then they wanted to make a drop. So what they do is they hold near high and induce the traders to feel that this resistance turns support and try to buy and don't give profit booking opportunity and then drop. So when they do the lower level consolidation, don't worry, definitely they will make a rise. They will not continue to drop at all. So it is the trick of the trade. So once you understand the trick, you can just laugh at them. Okay, you do all your trick. I'm not worried about it because I know what is your intention is. You will be able to really say that and trade at ease. See, I'm only interested in small traders making money of this way. I'm not interested in the big people trying to do that. Because small traders invariably lose plenty of money in the market beyond their capacity. So my forecast is in relation to the numerator currencies. And as I explained that when the numerator currencies gain, it doesn't mean the denominator currencies have to drop. They can gain the levels also. Now you are seeing all the currencies showing negative net change, like a contrarian move. So that we can find out only with the help of the net change from the previous day close. Okay, the macro trend reversal for 2014 they are supposed to hold low till March. So they already done some portion of drop from that of 1.38 area in the case of Euro and 1.66 in the case of GBP. And, they cannot continuously drop, and once they create the bearish field, a lot of traders tend to sell. Then in that case, they cannot drop it. If they drop, the people will book profit. So what they have to do? They have to quickly gain the level and hold at a higher level and do higher level consolidation with that down upward stop. And after that only they can make a big drop. Otherwise the drop will be for intraday drop like 100 pips. Nothing more than that. So that is not a real trend. So they are expected to make probably next week or week after that, they will make such big move of 300, 400 pips drop. In the case of Euro and GBP, for that they have to do high level consolidation with upward stopping. Then afterwards, from April, they are expected to gain the levels again in this year. Then USD gains sentiment and GBP is bearish sentiment. Okay. Now, in order to change the market, see how they can change the market sentiments, they have to make some moves, no? Because they cannot tell everybody to announce in TV. Okay, I may not listen to TV. They cannot ask everybody to display it in the website. I may not look into the website. So, in what way they can reach every trader? Only by making quick moves in of the quotes. So, that is why any trader has to necessarily see the price in the trading platform or anywhere else. So, when they make such quick moves in the platforms, what they do is they quickly drop GBP in order to create the bearish sentiment in the case of Euro, GBP and Australian dollar. Otherwise, in order to make US dollar gaining sentiment, they drop GBP. They drop USDN in order to make US dollar weakening move. Any more explanation in it? Okay, the market code page is showing only the current time. And therefore, how do you determine the price in the past? Okay, there is no need to refer to that of the past time, past level. We have the high and the low for a relative comparison of where the market stands. So what you are going to do, that they have been holding Euro around 1.36 from start of the Japanese session. We will simply use the word consolidation. But ultimately, we can use the chart to make descriptions of the market or the market comments. What had happened last 2 hours or last session. We can just say that session roundup during different sessions. And okay, you use that. Will you be able to take a trading decision on that? Because we know that intraday, they bring in the trend reversal. When exactly they are going to bring in the trend reversal, we need to identify that. Okay. Okay. Then USDN, GBPN, yeah, they are expected to make the USD weakening. So time is up. I have to wind up. So I take this opportunity to thank FX Trade for the facility provided to present the monthly twin webinar. And these are all my contact details. I take this opportunity to thank everybody who have come here to listen to my webinar and try to reflect on that. I'm not trying to induce you to follow any of my system, and just try to reflect on that. At least don't go with another herd of traders, and try to see that you are able to sense it with the help of the common sense. Okay, target for Euro, 45 pips from that of the entry. I just explained it. 45 pips from that of the entry. So around 36.70. So these are all my contact details, and those who want to get more information can send an email or contact me through chat, and I'll be willing to help without expecting anything from you. And it's only to help the small traders. And I will come back next week and take up yet another session of Asian Session Live Market Analysis. Thank you one and all. Sorry for the delayed close, FX trade. Hope you will not mind it. Thank you one and all. See you next week.